Thank you for joining us for today's webcast on tax planning and incentive for contractors. I'm Jeff Rogers, and I'm a tax partner at Feeley Driscoll, which is a Boston-based regional accounting firm. Our construction group specializes in providing tax and business consulting services to construction companies across New England. Today we are going to take a look at some of the tax incentives that are available to contractors, as well as some of the strategies to save on tax. If you have additional questions, please feel free to contact us at 888-875-9770 or visit us on the web at www.fdcpa.com. We'll start with the DPAD deduction, which stands for the Domestic Production Activity Deduction. Hopefully, if you're a contractor listening to this webcast, you're familiar with this deduction, and more importantly, you're taking advantage of it because it really is a favorable tax break. The deduction has been around since 2005, and it was put in place as an incentive to U.S. companies to perform construction and manufacturing activities domestically rather than overseas. Engineering and architect projects in connection with these construction projects may also qualify for the deduction. DPAD is a deduction equal to 9% of a construction company's qualified production activity income, or QPAI for short. This works out to a 3.5% tax savings if you're in the maximum tax bracket. QPAI is basically your net income derived from construction-related activities. If at least 95% of your revenue sources are from what's referred to as Domestic Production Gross Receipts, or DPGR, QPAI will basically equal your net taxable income. And that's all there is to it. No cash outlay, just a simple 3.5% reduction to your tax bill. If you have any concerns over whether you are taking full advantage of this deduction, feel free to give us a call. We're going to move on to the area of accounting methods. This is not going to be a full-blown discussion on accounting methods, as we'll likely do a separate webcast in the future on the topic. We just want to make sure that you are aware of some of the options that are available to you. Percentage of completion is clearly the IRS's preferred method of accounting for construction contractors, and many contractors use the method for your GAAP financial statement reporting. For those not completely familiar, revenue is recognized under the percentage of completion method by multiplying the contract price by the percentage of costs incurred to date over the total estimated costs expected to be incurred over the life of the contract. Be aware that the percentage of completion method is only required for long-term contracts. Long-term contracts are defined in Section 460 of the Internal Revenue Code in general as construction contracts that span over 2 tax periods. Only large contractors are required to use the percentage of completion method. That is, contractors with average gross receipts over $10 million for the prior 3 tax periods. This leaves a lot of opportunity to defer the payment of income taxes by using a method of accounting other than the percentage of completion method. The cash method and completed contract methods are 2 methods of accounting that could be used that provide the most tax savings. Under the cash method, you recognize revenue when received and deduct expenses when paid. Under the completed contract method, you defer the gross profit on the contract until the tax period in which the job is completed. Under either scenario, you are pushing the payment of tax off into a future tax period, so it's the time value of money that you're benefiting from. In addition, the Internal Revenue Code provides exceptions from the percentage of completion method for home construction and residential contracts. In the case of a residential contract, 30% of the profit may be exempted from the percentage of completion method. A home construction contract is one in which 80% of the total estimated costs are incurred in construction-related activities involving dwelling units within buildings containing 4 or fewer units. Each unit within a town or row house would be considered its own unit. Same definition for residential contracts, except there are more than 4 units in each building. Now, if you have engaged in home construction or residential construction contracts in the past and you have not taken advantage of the percentage of completion method exceptions, you cannot just start doing it now. You've already established an accounting method. Similarly, if you have not previously used the cash or completed contract method, you must continue until the point in which you have notified the IRS of your intention to change your method of accounting. In some cases, you would require advance permission. Feeley Driscoll are experts in matters related to accounting methods and have significant experience in applying for changes. Please contact us if you would like to explore any of these options. Use of the percentage of completion method requires an interest calculation referred to as the look-back method. Basically, when the job is complete and the total contract costs are known, the IRS requires that you look back to any prior periods in which the job was in process to determine whether or not income was over or understated. when compared against the cost estimates that were used at the time. If your costs were overestimated and there was a profit pickup at the end, you owe the IRS interest. If the job faded, the IRS will owe you. There are no real planning opportunities, but it's important that you understand when it is not necessary to calculate a look-back. First, look-back is not required to be calculated on contract prices that fall below the lesser of 1% of your prior 3 years' gross receipts or $1 million. Second, there is a small contractor exception that applies when average gross receipts are less than $10 million and the job is estimated to take less than 2 years to complete. And third, an election can be made to disregard the over or under statement of income on any contract that was estimated within 10% accuracy. If you have any concerns over the way you've been calculating look back, please feel free to give us a call. The last incentive that we want to discuss is the research and development credit. That's right, the R&D credit. The general view over the years has been that a construction contractor could not possibly do anything that could be classified as research and development. In reality, that's just not true. The R&D credit does not require the research result in a patentable item. Rather, it is available to companies that incur qualified research expenses to improve their own internal processes. In a construction context, qualified expenses could be incurred for a project in which the contractor experiments with new material combinations. Or perhaps you're incurring costs in the effort to develop innovative assembly or construction methods that accelerate or improve the construction process associated with large infrastructure assets. Or you have to experiment with unique construction or innovative techniques for untested environments or involving unique structures. Even expenses incurred to design and develop energy-efficient buildings or other green designs could warrant consideration for the credit. Qualified expenses would include wages paid to employees that perform the R&D services or amounts paid to independent contractors for the same purpose. And any supplies used in the process would also be creditable. It's important to remember that the company should already be deducting these expenses through their P&L, and you cannot double dip and take both a credit and a deduction for the same expense, so the expense is disallowed. In some instances, this may produce a negative result if the taxpayer is in a position where they are paying AMT. The R&D credit is only allowed currently to the extent that the taxpayer's regular tax liability exceeds their AMT liability. Some construction contractors are perpetually in an AMT position. Fortunately, the credit does carry forward. To mitigate this potential trap, there is an election that is available referred to as the 280C election that may be made on a timely filed return. When you make this election, you claim the deduction for the expenses incurred in exchange for a 35% reduction in the credit. When making this election, the worst case scenario should be that you wind up in a neutral position in the current year with less credit carried forward into the future. This concludes our webcast on tax planning and incentives for the construction contractor. If you have any questions, please contact us at 888-875-9770 or visit us on the web at www.fdcpa.com. Again, my name is Jeff Rogers, and thank you for joining us.